welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finances, and our hope is that by the time you get to the end of this series you are better equipped to make sound financial decisions. If you are new here, thank you so much for stopping by. We really love having you on board. And if you're already a subscriber, thank you so much for always sharing the videos with your friends and family, as well as always leaving a comment in the comment section. That way we get to interact and learn from each other. Today I'm super excited. I'm going to do a video in response of one of the Facebook posts that I did recently, where I highlighted the difference between a taxable account, a tax advantage account, and a tax exempt account. So a lot of us, if you're a salaried employee, you'd notice that the money that you get in your account is after a couple of deductions. Those deductions could range from maybe social security, if you contribute to any social security, medical aid, and it will also be after any pension or provident fund that your employer has arranged with the employee force, and any group life cover if there's any, and the biggest chunk of most of our deduction is normally the income tax. So that means what lands in our bank account at the end of the month is what we call post-tax money, meaning money after the taxman or the receiver of revenue in Namibia has already taken its share. So then what you do with that post-tax money would differ, and you could be paying another tax on top of that tax post money, or rather that post-tax money. Tongue twister there. So if you now take the money that you get from your employer as salary and you go invest it in a typical bank account at, for example, a 32 bank account with whatever local bank you are banking with, that money is post-tax money, and the interest that you get from that bank account is taxable. So you are paying tax on the growth of your money after you've already invested money which you've paid tax on already. So basically you are paying tax twice, and that is something that you need to sort of be, when you are structuring your finances, you need to be bearing in mind. There are also some accounts or some savings or some financial decision that could be called tax advantage accounts. So tax advantage is something that enables you to defer tax in the future, and essentially when you go pay that tax in future, you're going to be paying it at a lower tax bracket. So I don't know how familiar you are with the tax bracket. So basically the receiver of revenue has come up with a scale to say that if you earn between X amount of money to X amount of money, you pay this much tax. And because Namibia sort of used like a worth-based system, the more money you get, the more tax you pay. So what we are saying here is you are like, with the tax advantage account, you are likely to defer the tax consequences of whatever decision you are making into the future, and hopefully at that time you won't be making that much of a lot of money. For example, if you become a pensioner, you will preferably then be falling in a lower tax bracket, and the payout that you're going to be getting from that money would therefore essentially save you money. So a typical example of a tax advantage account could be a pension or a provident fund. That means when you contribute to a pension during your working career, that money, you get it as a deduction. That means it allows you to pay a lower tax now. But in future, when your pension is paid out, you will be a pensioner by then. Hopefully you won't have a salary at that point in time, meaning you'll be, the only income that you'll be getting is pension money and other few investment income. If you have, that means you'll be potentially in a lower tax bracket, and therefore you'll be paying a lower tax. So that's an example of a tax advantaged account. It's something that you do today, like contributing to a retirement annuity, that is saving you money because you are able to claim that as a deduction now, such that in future when you get a payout from that pension or that retirement annuity, you will be falling in a lower tax bracket and ultimately hopefully pay a lower tax. So that is a tax advantage account. And lastly, I want to talk about tax exempt account. From a tax perspective, if something is tax exempt, it means that you are exempted from paying tax. You are excluded from paying tax. So if you were to get money from a particular investment, your growth from that investment won't be taxed. A typical example in Namibia is dividends. If you get a dividend from a Namibian company, you don't get tax on dividends. So that is one of the tax exempt income in Namibia. But also you could be saving with a particular institution that is exempt from tax. For example, interest income earned from a postal bank. For example, in Namibia, if you invest your money into NamPost is a postal bank, you don't get charged interest on the income that you earn from NamPost, for example. So really, why am I highlighting this? I just want you to understand that you could be paying tax twice if you're not smart with how you invest your money. You could be deferring your tax, hopefully at a future date. Not that you are completely avoiding it, but such that at that point in time you're going to be in a favorable position from a tax perspective. Or you could be investing in something that is not taxable, meaning the growth that you get from the money that you invest is actually not taxable. So the difference between the taxable account and the tax-exempt account, in both of these instances, you are dealing with post-tax money. You've already paid tax on your salary. You either go and invest it in a bank account that is going to give you interest that is taxable, or you invest it in shares that is going to give you dividend that's exempt. So those two are both post-tax money. Whereas a tax advantage account like a retirement annuity, it's pre-tax money. It's money that tax haven't been deducted from, and therefore at some stage is going to result in future consequences. The choice is up to you to make sure that you educate yourself with these financial terms, you educate yourself with the consequences of your investment option, and hopefully you can save a few dollars from that. That's really all I had today from this discussion. Very brief, high level, and hopefully you've learned a thing or two. If you have any further question on tax in general, you can also leave it in the comment below. Then I will see if it's a popular question that I can perhaps do a follow-up video. Otherwise, I can just respond to you in the comment section. Thank you so much for always tuning by. I'm really honored to have given us your time to be with us on the wave. Until next time, it's goodbye, and as always, please keep safe. Bye-bye.